What's going on, everyone? Welcome back. Today we need to talk seriously about XRP, the recent price collapse. And the big question on everyone's mind right now is this finally the bottom, or do we still have more downside ahead? Just a few days ago, sentiment was extremely bullish. Many traders, including experienced analysts, expected continuation toward the mid-150s. Instead, the market flipped hard. Support broke, and price slid fast. If you're feeling frustrated or caught off guard, you are not alone. This is exactly how volatile crypto markets behave around key macro data and technical inflection points. Today, I'm going to walk you through what changed, what the indicators are showing right now, what the broader market environment looks like, and what I expect over the next couple of days. Let's start with the chart structure and what actually caused the breakdown. XRP dropped sharply from the recent highs in the $1.60 area down into the mid-$1.30s in a very short window. That kind of move is not random. When you see a fast multi-day sell-off like this, it usually comes from a combination of leveraged liquidations, macro pressure, and technical support failure. Once the prior support zone gave way, stop losses stacked underneath started triggering automatically. That creates a cascade effect. Forced selling pushes price lower, which triggers more stops, which pushes price lower again. It feels dramatic when you watch it live, but mechanically it's very common. Now here's where it gets interesting. When we shift from price to momentum indicators, especially the daily RSI, we're approaching oversold territory. The RSI reading is hovering in the low 30s. Historically, on the daily time frame, XRP rarely stays under that zone for long unless we are entering a much larger macro downtrend. Oversold does not guarantee an instant reversal, but it does tell us that the speed of selling is reaching exhaustion levels. Think of it like a stretched rubber band. The more stretched it gets, the stronger the snapback tends to be once selling pressure fades. Volume behavior adds another layer to this story. During the biggest red candles, volume spiked aggressively. That confirms panic selling and forced exits. But as price pushed slightly lower afterward, volume began to taper instead of expanding. That kind of pattern can signal that sellers are running out of fuel. When price makes marginal new lows, but volume does not confirm with new highs, we often see at least a relief bounce develop. Let's zoom out for a moment and talk about the macro backdrop, because this drop did not happen in isolation. The latest inflation data came in hotter than markets expected. That shifted interest rate expectations again and strengthened the narrative that monetary policy could stay tighter for longer. Whenever that happens, risk assets, including crypto, tend to react negatively in the short term. We also saw broader weakness across multiple large crypto assets at the same time, which confirms this was not XRP-specific panic, but part of a wider risk-off reaction. Right now, we're entering a short window where the economic calendar is relatively light. That matters more than most people realize. When there are no major reports or central bank announcements, markets often drift back toward technical behavior instead of headline-driven volatility. In these data-quiet windows, oversold conditions and positioning imbalances tend to correct themselves. That increases the probability of a short-term rebound attempt rather than continued straight-line selling. There's also a positioning factor in play. After a sharp breakdown through support, many short-term traders open short positions late in the move, expecting immediate continuation. That creates a crowded short trade. If price stops falling and starts climbing even modestly, those late shorts are forced to buy back to exit. That buying adds upward pressure, what traders call a short squeeze. Short squeezes don't need bullish news, they only need price to stop going down. From a structure standpoint, the key zone to watch on the upside is the former support area around the mid-$1.40s. Markets often retest broken support from below. What used to be a floor becomes a ceiling. If a relief rally develops, that's the most logical magnet level. Reaching that area would not automatically mean the full uptrend resumes, but it would be a technically healthy reaction after an oversold drop. On the downside, what matters most is whether price starts closing daily candles decisively below the recent panic low. Quick dips are one thing, sustained acceptance below that level is another. If we see repeated closes under it with expanding volume, that would suggest a deeper correction phase is unfolding. But if price keeps rejecting below that zone and snapping back, that behavior supports a base-building process. There are also a couple of developing themes traders are watching this week. One is renewed discussion around crypto ETF flows and whether capital rotation is shifting more toward large-cap assets versus mid-caps. Another is ongoing conversation around cross-border payment adoption and blockchain settlement efficiency, topics that tend to bring XRP back into the spotlight whenever institutional payment rails are discussed. These themes don't create instant price moves, but they influence medium-term sentiment and capital allocation. So what's the practical takeaway for the next couple of days? Conditions are lining up for a relief bounce attempt, based on momentum exhaustion, declining sell volume, and crowded short positioning. That does not mean straight up. It means the probability of upward reaction is increasing compared to continued freefall. Volatility will likely stay elevated, and intraday swings can still be sharp. Traders should expect fast moves in both directions rather than smooth trends. If you're a short-term trader, this is typically the phase where risk management matters more than prediction. Oversold markets bounce, but they also fake out. If you're a longer-term holder, this is historically the zone where emotional selling tends to peak and regret tends to form later. Emotional decisions cluster near extremes, both tops and bottoms. Over the coming sessions, watch momentum, watch volume, and watch how price behaves when it approaches the mid-140 area. That reaction will tell us whether this is just a technical bounce or the beginning of a stronger recovery leg. No hype, no guarantees, just reading the data in front of us and adjusting as it changes. Markets are probabilistic, not certain. Stay disciplined, stay flexible, and don't let one violent move define your entire strategy. If you found this breakdown helpful, make sure you're subscribed, and I'll follow up with an update as the structure develops. Stay steady out there.